All right, let's talk medtech. It's one of the most exciting, high-growth sectors you can invest in. But wow, can it feel complex? So how do you cut through all that noise and actually find the real winners? Well, that's exactly what we're going to do today. We're going to break it all down with a clear 5-part framework for investors. Let's dive in.
So here's our game plan. We'll start with the big picture, the industry's growth engine. Then we'll zoom in on what makes a company defensible, its competitive moat. After that, we'll talk about the magic of recurring revenue, then get into the nitty-gritty of reading the financials, and finally wrap it all up by figuring out how to weigh the risks and rewards.
First up, the medtech growth engine. Look, before we even think about analyzing a single company, we have to understand the massive currents that are pushing this entire sector forward. These are trends that are going to be in play for decades.
So this is really the fundamental question, right? Where is all this future growth actually coming from? And the answer isn't just about cool new gadgets. It's rooted in some really profound, unstoppable shifts happening in our world.
And here are the big ones. First, we've got an aging global population. I mean, just look at this stat. 2.5 billion people are expected to have hearing loss by 2050. That's huge. Then you have the rising tide of chronic diseases like diabetes, and we're also seeing major social shifts, like the fact that infertility now affects 1 in every 6 adults. What this all adds up to is a massive, growing, and, this is key, a non-discretionary market for advanced medical tech. This isn't stuff people choose to buy, it's stuff they need.
Okay, so we've established that a rising tide is lifting all boats. But how do the best companies make sure they stay on top? That brings us to our second section, building an unbeatable competitive moat. It's not enough to have a great product. You have to be able to defend your turf.
So what is a moat? It's pretty simple, really. It's just a lasting advantage that keeps competitors from eating your lunch. Think of it like the deep, wide ditch around a castle that protects the profits inside. And in medtech, these moats can be incredibly strong. In the medtech world, you'll typically see these moats come in 3 main flavors. First, you've got the high walls of government regulation. Second, the powerful bond of brand and customer loyalty. And third, the sticky web of integrated systems.
For a perfect example of a regulatory moat, look no further than Bonesupport. They did something brilliant. They didn't just get their product, CeramIt G, approved. They used a special de novo pathway with the FDA that actually forced the creation of a brand new device category. You see what that does? It means any competitor who wants to follow them now has to clear a much higher bar, a bar that Bonesupport basically helped set. That is a massive advantage.
Now let's talk brand loyalty. Check out this number, 12. For 12 consecutive years, the medical imaging company Sectra has been voted #1 by its U.S. customers. This is way more than just a nice trophy. It's a fortress. When customers are this happy, they just don't leave. A churn rate of 0.6% is basically zero. The cost and headache for a hospital to switch is just way too high. And finally, we have the integrated system moat. A company like Vitrolife is a master of this. They don't just sell one thing to a fertility clinic, they provide the whole shebang. We're talking consumables, genetic testing, special incubators, the entire workflow. Once a clinic is set up with this whole ecosystem and their staff is all trained on it, it becomes incredibly sticky and really hard for a competitor to wedge their way in.
All right, let's move on to a concept that investors absolutely love, the shift to recurring revenue. This is all about moving away from chunky, one-time sales and towards a smooth, predictable stream of income.
The difference is night and day. On one side, you have the old model. You sell a big, expensive machine, it's a great payday, but then you're back to square one, hunting for the next big sale. It's lumpy and unpredictable. But on the other side, you have models that are just beautiful for investors. Think of revenue as razor and blades model. Sell the device once and then sell a steady stream of disposable probes forever. Or Sectra's cloud software subscriptions. It's stable, it's predictable, and it's high quality.
And if you want to see the power of this in action, here you go. Just look at the insane growth in Sectra's cloud business. Up nearly 56% one year, almost 49% the next. This isn't just growth, it's high-quality, compounding growth that you can count on. This is exactly what gives investors the confidence to bet on a company's future.
Okay, so we've covered the market, the moat, and the business model. Now it's time to roll up our sleeves and actually dig into the numbers. In this next section, we're looking for the key signals, both the good and the bad, on a company's financial statements.
Now this is the chart every single growth investor dreams of finding. It is the classic hockey stick. What you're seeing is Bonesupport's revenue just exploding after they got into the US market. You see that long, flat period and then boom, an inflection point. This is a massive green flag that tells you the company has hit on something big.
And here's another number that should make you sit up and pay attention. 92.6%. A gross margin that high is just incredible. So what does a number like that actually tell you? It tells you the company has serious pricing power. It means their product is so valuable that customers are willing to pay a huge premium for it, and it costs very little to make. That is the magic formula for profitability.
But you know, it's not all hockey sticks in 90% margins. A smart investor is always on the lookout for red flags too. Even the best companies run into trouble. Take Vitrolife, a clear market leader. Their profitability recently took a hit. And this is when you have to put on your detective hat and figure out why. In this case, it was a nasty mix of currency headwinds and rising costs.
And this number right here, this is what that red flag looks like on paper. A 700 basis point drop. That's a full 7 percentage points in your core profit margin in a single quarter. That's a big deal. It doesn't mean the company's broken, not at all, but it is a screaming signal that something has changed, and it absolutely requires a much, much deeper dive from any potential investor.
And that brings us to our final critical section, weighing the risks and rewards. Because let's be honest, no investment is a sure thing. The last step in any good analysis is to take all those fantastic positives we found and weigh them honestly against what could go wrong.
A risk matrix like this one is a really great way to organize that thinking. You can see that even the strong companies we've talked about today face real, tangible risks. There's always competition from huge, deep-pocketed rivals. There's execution risk. Can a company successfully launch a new product or integrate a big acquisition? And of course, for any company operating globally, currency fluctuations can wreak havoc on your reported earnings.
And all of this work, analyzing the market, the moat, the business model, the financials, the risks, it all boils down to this one final question. Does a premium company deserve a premium price? You might find the best company in the world, but you still have to ask yourself, is it worth what the market is charging for it today? And that, right there, is the art and science of investing.